Hello everyone, welcome. Wherever you're joining us from, or if you're listening, at the moment, kindly like, subscribe, and share. Like we mentioned, we are on a journey to help as many persons at their different levels of experience um, in their trading journey. Okay, so we are trying to see how we can unravel the things that you will not see on mainstream media as regards the forex market, the forex industry. So do well to help as many persons as can to actually see this and and actually participate in it. So we want to see how we can carry as much person as we can, you know. So please help us do that as well as you benefit from whatever is happening here. So last week, sorry, not last week, our previous class, we talked about the single candlestick pattern formation. Okay, and today we are going to be talking about the double candlestick patterns. The reason why we are building it step by step is so that at whatever level of in your trading journey you are, you can actually be able to connect the dots and then have a good advantage to success. So on the double candlestick patterns, you look at, if you can see my screen, you would notice that it's on sides. You see the bullish, candlesticks, and then you also see the bearish candlesticks. Okay, the bullish candlestick on my left and the bearish candlesticks on my right. So the first one you see there is called the bullish kicker. It's a formation um, that shows how that the market was at a point, bearish, but then it, it came to the point where the pressure became so high because of the presence of the buyers in the market and pushed the price up with a very high momentum. That's you even see a little gap. Okay, so it shows a very high. I mentioned something as regards volatility. I mentioned something as regards the momentum, you know, in our last listing. So this shows the presence of heavy participation, in buyers in the market. So the it flips the price, from being bearish to becoming bullish. So once you see that, you know that there's a very strong, participation of buyers, and the market is likely to rally up. You know, so and then when we get into the advanced, and you will get to see how it is traded. Then the next one you see on the bullish is called the bullish engulfing. Now the bullish engulfing is one of the primary um, signals you find on charts. Is one of the most occurring signals. Okay, like I mentioned, when it comes to forex trading, there are a lot of things that happens more often in the market, and there are some you can't even find often. For example, like the bullish kicker, it's rare you see the bullish kicker in the market, but the bullish engulfing is um, you see it almost at some time intervals like that, and which is a very good signal, that it is important about the engulfing pattern. Okay, then another signal, another okay, and why is it like that? You realize that what happened was that the the, the presence of the sellers were in the market, and somewhere down the charts, somewhere at the demand zone or at the support area, you realize that at that price range it became attractive for the buyers to get into the market, and they pushed the price up, and then the candle, you know, now engulfed the order. So the buyers now overpowered the sellers, and what it means is that the 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 presence of the buyers in the market now, means that there's a very high tendency that the market was going to reverse, to become bullish. So that's the bullish engulfing. Once you see it at the down part of the chart, especially at higher time frames, you know that there's a very high tendency that the market is going to reverse. So the next one you see, which is the third one, is called the bullish harami. The bullish harami, how does it form? Well, the bullish harami is a candlestick pattern where you the sellers already were in the market and the price was going down, and then at a point you now realize that the buyers came. So you see that there's a presence of the buyers, but now it didn't look like they completely overpowered because the price didn't close above it. So it's like a mother candle, and then there's a baby candle. So, and what you find next is that there is supposed to be another candle that should open at the top of it. So the harami candle closes in between the mother candle, which forms the baby candle, and then the next opening candle should be, a bullish candle as well. If it is a bullish harami, indicating, the the change in the market direction. Okay, indicating the change in the market direction. I think let me just show us a little, bits of what I was trying to explain. Okay, now look at it. This is the engulfing bar. This is the engulfing bar. What does it actually mean? What does it actually entail? Like I said, it's how a bearish engulfing bar, pattern. Okay, let me show you. So this is it. You realize that this was at the top, at the supply zone. The buyers had pushed the price to the top. Okay, and then at a point you now realize that the sellers came and pushed the price down. This is for engulfing. Came and pushed the price down to a point, and you notice what happened. The price has actually reversed and then sold to where you see here now. So it's an indication that that there's going to be a reversal. There's going to be a reversal. So this is the bullish engulfing. This here is a bearish, and this is a bullish, like I mentioned. So find a small body candle and then, engulf by a bigger body candle closed above it, and that's for the engulfing. So you can see it on the chart here, examples on the chart. We're going to get into that later. Some of the other ones explaining them, but I'm trying to show you something. So we are currently on the candlestick pattern formation. So what I'm showing you is as regards the engulfing. But so that's it. The next one we're talking about here, which was the third one here, is the bullish harami. Okay, so I wanted to show you also the bullish harami. Now look at it. You find a mother candle, you know, then you also see a baby candle, which is a smaller one. So the sellers couldn't move the price to close below the previous candle. So the buyers had entered the market, and then they pushed the price up and closed inside of it. Now this harami candle, if it is on a bullish trend, okay, if it's on a strong bullish trend, it's and it's still rallying at a very good point where you know that, because depending on the curve, there's something called the curve. There's something called it just depends on where the price in the market is at that particular curve. Some persons call it the range. Okay, Some people use Fibonacci to measure, at the point where the market is. If it's a mid range, mid this in point, or if it's at the top, or if it's down, so you can actually know, you know, at what point the market is. So because this has anyway, we'll get to talk about this thing later. We'll get to talk about it later. So if you find this pattern, at the downside of the curve, which is the supply area, or the a support area, then you sorry, which is the demand area or support area, you see the smaller candle, which is the bullish one now, closes um, at the mid or somewhere, but closes still between it. You realize that the sellers couldn't close the price below, so the buyers were able to push the price up and closed at the middle, or somewhere, at the between the body of the candle. So it indicates that the strength of the sellers have been affected, and there's a likelihood that the buyers are going to overpower it. you know. So that's it. If you look at it, you see this is the other one was this is for the bullish harami, and this is for the bearish harami. It's also called the bearish inside bar. Okay, so it happens in the market also a lot. It happens in the market a lot. So sometimes there are some candlesticks you need to pay attention to. You may not be able to pay attention to all of them, but there are some that is highly recommended that you pay attention to them, because it is not everything in the market you will trade. It is high probability signals that you're supposed to trade. You have to be able to to sieve out all the noise, and then be able to stick to what works, to trade. So this is one of the double candlestick patterns you should also look out for in the market, in terms of when you're also taking your trades and confirming your trades and all of that, likely signal. Yeah, so this is it, the representation in the market, bearish and rami. You notice that it was it was at the top, of the chart, at the supply area. So you notice what happened there, and then see the market now, had lost steam. You find the bearish harami, and then before you know it, the market had to rally all the way down again. So that's just it. Then the next double stick candle I want us to look at. First of all, let's talk about the piercing line. The piercing line is has it is looks kind of like the army, but it's not the same. The piercing line was that the market at some point, okay, um, the bearish how do you call it, the sellers move the market price, and then market down, and then the buyers now push the price from down up again, you know, up again. So it means that that's even a very strong signal also. A very strong signal is called the piercing line. And if you see that, you know that the buyers have resumed, taking advantage of the discount in that price. I'm still talking about the bullish. So everything we're talking about the bullish is also kind of also represented in the bearish. So I may not want to go talk about the bearish again, because I don't want this video to be very long. Okay, um, so let's talk about the tweezer button. Now, if we come to the tweezer button, you realize that this bearish candle, and the bullish candle, the candles are more or less kind of the same length, the same size. Okay, so what happened was that the sellers moved the price at a particular time interval, so from one point to from the opening price to the closing price, and then the buyers now had to take up from the closing price, of the sellers at that time, and then they bought all the way and moved the price to where the market opened at the previous candle. Remember, usually candlestick formations are better used at higher time frames. Don't try to use candlestick formations, a lot on lower time frames. Higher time frames are stronger in making trading decisions than lower time frames. I hope that is clear. So they moved the price to the same point, yeah, almost the same point, almost the same point where the price opened at the previous candle or the sell candle. So what that means is that there is a very strong strength of buyers in the market, and the price is set to rally up. This tracer bottom, it means that this is found on at the bottom of the chart, and the buyers have come into the market. Then if you see the tracer top, it means that it found at the top of the chart, which is at the supply zone, and then the price is expected to rally down. So this is the tracer bottom, as you can see on the chart, and the buyers that come to the market move the price, and you can see it has rallied all the way to the top, and then somewhere at the top you notice that an arami, yes, formed, a bearish arami formed at the top there, which was to bring down to bring the price down. So all of these things are things that you see a lot. These are very frequent candlestick formations that you see in the market, and you need to pay attention to them, as well. So that's um that's it on the double candlestick formation, and we will get to do the three candlestick formation. So do well to to share, do well to like, do well to subscribe. If you can't find the long if you can't find a long this version on TikTok or Instagram, please go to YouTube. The link will be made available there, so you can actually see the full link, on the YouTube. Thank you so very much, and do have a great day. Bye.